Welcome to The Explainer. We're here to break down the big topics shaping your world. And today, we're digging into a really big one. We're going to look at why the last 30 years of stock market growth was, well, kind of an illusion, an anomaly. And more importantly, what the new rules of the game are for the era we're all stepping into right now.
Okay, so get this number in your head, 3.8%. For 3 straight decades, we're talking 1989 all the way to 2019, the real after-inflation profits for America's biggest companies grew at a stunning 3.8% a year. I mean, that's nearly double the pace of the 30 years before that. It was, without a doubt, an absolute golden age for investors.
So, what was the secret sauce, right? You'd probably think it was all about relentless innovation, brilliant CEOs, just unstoppable sales growth. But the real story? Well, it turns out it's a lot simpler, and honestly, way more surprising than that.
See, it all came down to 2 numbers that, well, they just can't go any lower. A brand new analysis from the Federal Reserve has basically uncovered this hidden engine that was quietly humming in the background, powering the market for decades. The thing is, as we're about to see, that engine has now totally run out of gas.
Okay, so let's really get into this, because this finding, it completely changes how you have to look at the last 3 decades of market performance. Seriously, it's a total game changer.
All right, take a look at these numbers with me, because the interesting part is the gap between them. If you start at the bottom, the growth in what companies actually sold, their sales, was a pretty modest 1.9% a year. Okay, then their earnings, before they paid interest and taxes, what analysts call EBIT, that grew just a little faster at 2.2%. So here's the million-dollar question. How on earth do you get from that 2.2% all the way up to that blockbuster 3.8% in final take-home profit? I mean, where did all that extra juice come from?
And here's your answer. This chart tells the whole story. For 30 solid years, the slice of the pie that companies had to pay in interest and taxes just kept getting smaller and smaller and smaller. It went from over 50% back in 1989 and was literally cut in half. And all that saved money, it went straight into the pockets of shareholders.
And here's the bottom line. That easy mode is over. This incredibly powerful tailwind, which the Fed figured out was responsible for more than 40% of all profit growth, has just stopped blowing. The winds have died. Interest rates and tax rates just don't have any room to fall further. The free lunch is officially over. For anyone investing, this means that easy, automatic lift that just boosted pretty much everything for decades. It's gone.
Okay, so if the old engine is dead, what's going to replace it? That question right there brings us to the absolute biggest story in the markets today, the almost desperate search for a brand new engine for growth.
Yeah, with that 30-year gift from falling rates totally used up, the market is basically placing a massive all-or-nothing bet. It's betting the farm on a new technological revolution to somehow create all the growth we need for the future.
And you really don't have to look very far to see what that bet is, do you? I mean, JP Morgan says it plain as day in their latest outlook, all the hopes for future growth are now pinned squarely, almost exclusively, on AI, artificial intelligence.
And listen, this is not some abstract, futuristic idea. The actual plumbing, the infrastructure for this whole AI revolution, it's being built and controlled by just a tiny handful of giant companies. You've heard of them, the hyperscalers that run the cloud. And people online, like on Reddit, they point this out all the time. Amazon's AWS and Microsoft's Azure are already the backbone of the internet as we know it. That gives them a ridiculous head start.
So you've got this massive, kind of frantic gold rush into anything and everything AI. And it has everyone asking the same really critical question. It's a question that, tends to pop up at moments like this throughout history.
So what are the ingredients for a market bubble? It's fascinating how consistent the pattern is, right? JP Morgan lays out the classic warning signs, and it's the same story from tulip mania all the way to the dot-com bust. Step 1, you need a big paradigm-shifting story. The world is changing forever. Then you add some widely available cheap credit, a growing disconnect between company fundamentals and their stock prices, and finally, a huge crowd of investors all piling in because they have a massive fear of missing out.
Now, the AI boom, it absolutely has that first ingredient, right? The paradigm shift narrative is definitely there. This technology is legitimately transformative. The real question, the thing you got to watch for, is whether those other ingredients start showing up. Are we seeing cheap credit everywhere? Are people starting to ignore fundamentals completely? Look, recognizing these signs isn't about trying to predict a crash. It's about understanding the difference between a rational, exciting boom and a speculative frenzy that's getting out of hand.
But here's the thing.
This whole AI story isn't happening in a vacuum. You have to zoom out, because it's playing out against the backdrop of another, equally massive shift, the complete redrawing of the global economic map.
Think about it. For the last, 40 years, the global economy was built on one single idea: efficiency. Find the absolute cheapest place to make something and then ship it just in time to wherever it needs to go. Well, that era is over. We're moving from a world of globalization to a world of fragmentation. The focus isn't on efficiency anymore, it's on resilience. It's not about just in time, it's about secure supply chains. It's not about the lowest cost, it's about reliable production, often within competing trade blocs. And this new reality, it forces everyone to focus on physical stuff again. Everything from securing energy supply chains, you see these huge LNG tankers, for example, to straight-up geopolitical competition with nations like China. It is now a world that is driven by security, not just by the lowest price tag.
So what's the catch? Well, there's a big one. This new world of resilience and security, it comes with a cost. Building all these secure, local, sometimes redundant supply chains is just flat out more expensive than the old hyper-efficient model. And what does that mean for you and me? It means that the era of super low inflation that we all got used to is probably over. And that's going to mean higher and much more volatile inflation for the foreseeable future. So in this new, higher pressure world, with all these giants and resources and walls, what are the new rules for growth? What does it actually take to win? Because the old playbook just won't work anymore.
Rule number 1, physical stuff matters again, big time. And there is nothing more fundamental than energy. I mean, look at this data from JP Morgan. It's pretty clear. Having access to cheap electricity, like the US does, gives you a massive, massive advantage, especially in a world that's about to plug in millions of power-hungry AI data centers.
And another thing, in this environment, the biggest companies are just poised to get even bigger. Think about this. The top 100 US companies already rake in 75% of all the earnings. They have nearly double the cash flow of other big companies. That gives them just immense power to invest, to gobble up competitors, and to completely dominate new fields like AI. You know that old saying, a rising tide lifts all boats? Well, it feels like that's changing to something more like, the biggest ships are the only ones that can handle these waves.
And honestly, this comment from a Reddit user just nails it. They're talking about Microsoft and how for so long people kept writing them off as this old, boring relic. But their dominance, their sheer size, the fact that they built so much of the software that already runs the world, it gave them the perfect launchpad to just dominate the AI race. It's a perfect example. In this new era, being a giant might be the ultimate advantage.
Which, of course, brings us to the final and maybe the most critical question of all. In a world of giants and walls, is growth just for the few? As those old, easy tailwinds, the ones that lifted everybody, fade away, are we stepping into a new era? One where all the immense growth from AI and all the security we now demand just ends up concentrating more wealth and more power into fewer hands than ever before.